Welcome to the Cashflow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cashflow Project Podcast. I'm your host, Steve Fieros with Tri-City Equity Group. Back this week with another episode. Today, excited, we've got Matt Medrano on the show. So Matt is a managing partner and CRO of Dynamo Capital, a private lender based in Kansas that specializes in both short-term rehab loans and long-term DSCR financing. He's got a background in economics, real estate, and commercial lending. Matt has built multiple multi-million-dollar pipelines while helping investors access flexible capital solutions outside of the traditional channel. So in just 2 years of founding Dynamo, they've become the number one private lender in Kansas with a 30 plus market share. And maybe he's got some updated numbers there, but they achieved this by solving that middle market problem, right? Offering DSCR loans for 5 to 10 unit properties, entity only lending, and creative tools like cross collateralization and portfolio consolidation. And if that's a mouthful for you as a listeners, Matt can dive into what that may mean for you as an investor, but excited to have him on and talk shop in the world of lending. Matt, welcome to the show.
Hey, thanks for having me on, man. That was a great intro. I couldn't have written it better myself, but I appreciate it. I'm happy to be here.
Yeah, no, happy to have you on. So obviously we're going to dive into what Dynamo offers and how you guys are managing the market and what you can offer to investors. But before we get there, how did you get to where you are? Obviously you guys have achieved a ton of success in a short period of time, but as I've known before, and I'm sure you can attest to, seldom is it like, hey, overnight success. Overnight success is usually decades-long journeys of being in the valley. So yeah, give us a little bit of your background for those of our listeners that may not be familiar with you.
Yeah, man. I think for me personally, my story is one of not really knowing where the destination was. And overnight, we realized we're here. Yeah. So coming out of college, Wichita, Kansas is an odd little spot. I went to school in a small town in Iowa. I went to Grinnell College. I stayed in the Midwest. But when I came back home, I knew all the successful people, quote unquote, that I knew or went to school with, or their parents. They worked at Coke Industries. And so that's headquartered out of Wichita. The crux of Wichita is like odd affluence that you have, a lot of really deep pockets here in Wichita for it being a small to mid-major market. It's not a big area. I describe Wichita as a very big small town, which I really like. Wichita is also the air capital of the world. It's earmarked by the Boeings and the Spirits and the Raytheons and Beechcrafts and all the airplane manufacturers. Generally speaking, if you see a plane in the air, it's come through Wichita at some point, which is pretty cool. That's where my grandpa was practically my father, grew up and worked on, and that was it. I grew up around planes, so I always thought I was going to wind up being in the airplane manufacturing business, and I'd be a line worker, and that was going to be maybe I manage a shift, and I'd be a big wig, as he called everybody there. That was what was my goals. I went to college and kind of reframed what as a first generation college student for my family. So reframed like what I thought was possible. And I joined Coke right out of college, graduated on a Sunday, started on Monday, immediately realized I was not a fit for one, the corporate world, and two, that role that I was in. I was a financial analyst. And coming out of college, I was much more interested in economics at the macro level, not the, hey, where's this receipt and what did we spend on this one particular part that a financial analyst in more of an accounting role really has to care about. So I was immediately uncomfortable, and I knew right away, oh, this is not for me. I don't want to necessarily conform to this. So I went to my boss I hadn't even received my second paycheck there and said, hey, I don't think you guys got what you want out of me. And I'm certainly not getting what I want out of the company. Let me have some time to figure this out. But I think I'm going to part ways with you guys. You have a ton of talent that is dying to work for Coke. It's a great company. It just wasn't the right fit for me in that particular role. And so I set out and tried to find something different. I got into, with my now father-in-law, which is a funny story, which we don't have enough time to go through, IT sales, enterprise IT sales. So think full-on data stacks and IT strategy. I was essentially brokering those here in Wichita. And the company, I really found a niche for that. I loved it. And the networking and the relationship building and everything is more relationship sales. I found a niche for that. But we got bought by a bigger company, and I was a rookie on staff. And ultimately, 101 of a merger is that bottom 25% is getting cut. I was naturally in the bottom 25 as I had just started within the years. I saw the writing on the wall. And the knock that I always had against me in that sales role was I didn't have enough experience. Just fresh out of college. I certainly wouldn't have bought anything from me if knowing what I know now. And I was on LinkedIn. I saw a job posting for Thrasher. At first, I thought skateboarding magazine. It was not. It's a foundation repair company that was moving to Wichita. And the classic LinkedIn post of make $100,000 in your first year. And I said, sign me up. That's more money than I've ever heard in my life. I want to do that. Won that job and got into the foundation repair space. Now, foundation repair is a big deal here in the Midwest and in Kansas in particular, Wichita in particular. We have a really expansive clay soil that just drinks water and moves houses and expands and swells up. Nothing like the volcanic soil that you guys have out in your neck of the woods. It's a mess out here. My grandpa used to describe it as gumbo when you're trying to dig. You can't plant anything. It's a mess. So very difficult place to maintain foundations and keep those houses nice and safe. There's a heavy market for it. I got into that and got a lot of reps because it was seeing 2-3 clients a day every week. And so I got a lot of reps and a lot of quote unquote closing trails and going through like how to build value in a quick way. The premise
This is also like a sales. It's
100% a sales role. Hey, my wall's leaning, send out a sales guy to come out and scope out what the issue is. Thrasher had an interesting approach where they were very high priced in the market. You were working for the forever home owner who wanted to invest in the property. And before COVID, that was available. The market wasn't as funky and things didn't feel as strapped and as tight. And I developed a pattern or a process of, look, I'm just going to take an x-ray of the home. I'll tell you what's broken. And I, like a doctor, will prescribe what needs to be fixed here and how to fix it. And if you want to do it, you can do it. If you don't. And in that time that I was at Thrasher, I led the Wichita team in terms of total volume and sales and all that stuff. And then the Kansas team and overall the entire company. I was the leader in that. And I built a reputation for knowing how to quote unquote close business. But I think the mistake that everybody always made with me, like internally, was like, oh my God, you must have I used to get all the time, like, you must have an amazing closing trail. Because it's all about getting the client to agree to that sale on the same day that you're there. And in some of these cases, they're $100,000 projects in some cases, right? On a $200,000 house, that's bad value. And I wasn't ever selling that, but like, some of these projects are really expensive. And for the right house, the last project I ever did in foundation was $250,000. That house, the 12-inch thick wall had just ripped in half. It needed a ton of work. But yeah, you got to build enough rapport with this client to get them to part with a $4,000 or $4 or 5 figure check to a contractor. You're already in a hole because everybody thinks contractors are sleazy or they're wrong or they're trying to trick you, take advantage of you. And you got a big price tag that comes with it. Nobody wants to spend money on their foundation. You're talking about buying another car with that money in some cases. So it's a tough sell. But I built a really good ability to build value, and I was never closing at the closing table. It was really, I was just taking a check. Right. There was never, I think you hear a lot of these like sales coaches and whatnot that here's how if money was no object, did you see the value in it, Steve? Did you tell me what you like about it? It's sleazy. I hate it. And that's not how I sold any of that business. It was, here's the matter of fact. This is what's wrong. Here's how we fix it. Here's why you want to fix it with me. What more do we need to do other than schedule your project? That was the way I operated. So built a really good relationship there. Unfortunately, I was 22 at the time, and I thought that I was untouchable there. I was really loud, and I always felt like I was advocating for the client, and we had a warranty. Let's figure out why we should do this warranty work and not have the little old lady that I just sold a $20,000 project to. She doesn't need to pay for this work. There's a warranty on it, right? We should be paying for this. So I was always advocating for them. I think I was advocating in the wrong way, or I know I was advocating in the wrong way. I was very combative, and I hit my quota, and that same day I was let go. So I was put on my ass right away. And I had just gotten engaged to my now wife. We had just bought a house. Life was beginning for us. And I got tossed on my ass. And I remember having to go home, and we had quarterly reviews, and I was scheduled for an 8:00 quarterly review, which is fine. It's construction. They start at 6 over there. And my meeting got moved up to 6 a.m. I was like, okay, but I live right by the shop. So it wasn't a big deal to me. I thought that's fine. You want to talk to your star? I'll get out and I'll set your tone good and no problem. And they came in and said, "Hey, we're letting you go." And I go, "What do you mean?" I said, quit messing with me. And they said, "No, you're out." Oh, great. I remember having to go home and tell my wife, our fiance, and I didn't know how to tell her. I was still in shock. It was a big deal. And then
Best thing you want to admit too. It's like you're about to get married to this
pride.
person. It's like a total pride thing. Hey, you know what? I just got fired. I know we're about to start our life together.
Yeah, man. And this is right before COVID, and COVID happens, and I struggle to find a spot that made sense for me. Luckily, another foundation repair company in town picked me up and wanted me to build out their sales team. And they were more real estate world focused, which is where I get my real estate touch now. Thrasher, you're 2 weeks out for an appointment if you called it. In the real estate world, we can't wait 2 weeks for me to get an inspection, let alone the 8 weeks that you got to wait for the project to get installed. So we're just on different timelines. So the company that I moved to was called IWP, and they had a much more aggressive approach, or they wanted to build out a more aggressive approach to service the real estate community. And so I started building meaningful relationships with realtors in town, property investors, fixers, flippers, owners of long-term holds. And foundation projects are something that nobody, generally speaking, budgets for or understands. It's the classic, we tore into this wall and we found out the wall was cracked or leaking or whatever. They're the unexpected expenses. So I saw a lot of flippers and investors struggle because, hey, I only got $10,000 of budget here, and you're telling me I need 15 to fix this, and it wasn't even on my radar. So it scared me away from investment altogether. I didn't have the stomach for it. I was happy to work on the projects for them. But every time I walked away from those projects, I was like, thank God that is not me doing that job. I built a network with investors and realtors, and they knew me as a guy that was common sense, quick, and I reserved the back half of the afternoon, for example, for any last minute things that came up. It is always the case that the 3-day inspection window that the realtors know about, that they know they can get into, all of a sudden they need an inspection the last hour of that 3-day window. And hey, not only do I need the inspection, I need the number now because we need to get it back to the lender. All that stuff's always a headache. Instead of trying to fight the nature of that beast, I said, why don't we just match it and understand what they're going through? Let's just block out the back half of the day for these emergency appointments and let's go take care of them. Good thing was we were starting quote on site. They knew what they were going to be looking at and built a reputation in that world. We were pregnant with our second, or I guess my wife was pregnant with our second, and some leadership changes at the company that I was in came along. And one thing that I can't stand, and one of the reasons that I started my own company, was I hate do as I say leadership, not do as I do. And I wound up rage quitting, called up my now partner, Justin, who had done a refinance for me for my personal home when COVID hit. He was a residential mortgage broker and at Sierra Pacific, one of the retail shops here in town. Did a refinance with him, got a 2% rate. Everything was super great and really enjoyed the experience with him. We're very similar age and lifestyles and everything. And we built a little referral network where I was sending my foundation projects to get refied with him because there was so much value in the home. So I was getting borrowers or clients of mine, the project paid for, the refinance done, their payments were lower, all wins around, and Justin was doing these refis. And now being on the mortgage side, I didn't realize how much money he was making on his side. He was making a much better deal than I was on my side, but we had a really good relationship. And he'd always flirted with me about coming over. And as he started his independent brokerage, being an LO for him. And I just didn't want to pull the trigger and jump over. We were pregnant with Blair, our daughter, and I was still unclear about, I got to restart in another field. Like, I don't want to do this. And I read a stat that was like in the first 5 years of post-grad, you'll have 6 different jobs or whatever that stat is. And I didn't believe it, but I absolutely crushed it in the different jobs that I held by then. And I was like, I don't want to move again and do another career change and explain this. And Justin was like, dude, rates are 2% right now. They're going to be 2% forever. The market's built on cheap money. And the economy's it can't go back. You can't shove 7% back into this. So I was like, kind of flirted with me and never pulled the trigger. And then I wound up rage quitting. And I just texted him. I said, hey, I did this. I'm starting next week with you. I just ordered the licensing test. Let's go. And as soon as I started, my license cleared at the top of the year in 22. Yeah, 22. And the rates obviously hockey stick to 7% before the summer. So I've sold the 2%. I've sold the 7s. All sucked. Did like roughly around $10 million in the residential space as a rookie LO in Kansas, which is a pretty decent deal. But I had all these clients that would hit me up for, hey, can you come look at this foundation for me? I know you're out of the business, but I was like, no, I don't want to get crawl space. Look, I was a 300-pound defensive tackle in college. I'm claustrophobic. I don't like critters. It's the last place I need to be, at basements and crawl spaces. In Kansas, those things are at most 3 foot tall, and gross. And I hated it, but I don't like bugs, and I just think about it all the time. Yeah, that's where I came from. And I got into, I lost my train of thought.
No, actually, there's a bunch there, because it sounds like that's led you up to where you are, like with the current lending business. But actually, there's a few different things too, right? This is why I like to dive into people's kind of background and their story, because it tells a lot. There's usually a lot of takeaways there. There's usually a lot of gems that people can take away that we can mine for. I love that early on, it reframed for you what was possible. Right? Like your initial thought of like, all right, this is what I could do being a kid who's, I'm going to be the first one to go to college, and the kind of traditional way of what somebody should be doing to be successful. It's actually, I could change that. I didn't have to be that. So it's, for a lot of times, the only thing that we can glean from is what we saw from like our family's experience, right? It's okay. Hey, if mom and dad did, work for the same company for 30 years and retire with a pension, and they work for the government or whatever, we think, wow, that's what I have to do. And it's actually, we don't live in that. Very few people live in that space anymore. It's just not available anymore, right? We're in a different kind of time period where there's so much disruption happening in the marketplace now. And I love that early on. It's, wow, you picked that up quick. It's, man, you reframe for you what you thought was possible. And then there's something too, like you pivoted early. It's, dude, you realize, hey, I stepped into this first job here, and I'm within that first week, I'm like, man, this is not for me. You just got out of college, and now you're going to walk. Yeah, this is actually not going to work. And
it's a big risk coming out of a liberal arts college. You take the first place, it's going to pay you over $45,000. And it was, in retrospect, a reckless decision to not have a plan before I told them I was quitting. But they were very good with me in terms of letting me stay until I got that figured out. So I really appreciated that. But man, I just knew I wasn't happy, and I don't see any value in doing that if you're sticking it out. I'm all about sticking something out and seeing it through, but also if there's no value in it to you, then
100%
direction. Yeah.
No, 100%, because like that, like you saw that, you pivoted early, because there's people that end up, and I've been doing this for 10 years. I hate it.
Sure.
Well, you knew you hated that from the first month, but because you weren't willing to take the challenge of doing something else, learning something new. You've been doing it for the last 10 years. You've been miserable. You've probably been making your coworkers miserable, your family and everybody around you too. It's when you realize that really early on, took action. Okay, no, we're going to pivot. We're going to do something else. And even just having that understanding of, man, I'm going to restart. Wow. Most people aren't willing to do that. And I think that's a takeaway. So, to me, it's a strong lesson for all of our listeners. Right. It's, hey, look, you're talking to two guys on the internet, we're just having a conversation, but this is great life advice. Hey, it's never too late. Look, if you're miserable doing something, I'm a man of faith. And so I believe, hey, God gifted us with each one of us with something unique. You got a skill set that you need to find out what it is. And it's like the jobs are there to help shape and guide your experience of life so that you can develop those skills. Right. Like for Matt here, he's, man, I picked this up on interacting with the clients and building rapport, and you're developing your skill set. You're developing those relational skills that, now have brought you to a point of success with the lending business that wouldn't have happened had you not, okay, we're not working with this company. Oh, no, I don't like this. Now, leadership. No, that leadership of that company's poor. No, I'm not going to do that if I ever own a business. So you're able to take things away from your different experiences. I think too often people don't do that. Hey, there's points of value wherever it is that you guys are working. If you're working, you don't like your job, that's okay. Hey, what is a takeaway that you can then apply to some other aspect of your life? Whether that be investing, whether that be just personal experience, whatever, take that, learn from it on. And Matt, your stories, you're sharing that. It's, to me, that's so valuable. And we haven't even got to the lending space. But
the lending job is really like a culmination of all the soft skills that I put together over everything else. And I think from a business perspective, we face these challenges every day. And I think the thing I struggled with whenever I left Coke and any decision I've ever made was like, they'll say perseverance and fighting through like the uncomfortable times is the key to success, or pushing through these tough moments so you could eventually get there. But I don't know if every instance of perseverance has a thing that's positive on the other side. I could have continued to grit it out at a company I didn't like with a boss that I didn't respect and I didn't want to work with. And I felt like I was taking the easy way out by going and doing something different. That turned out to be the best play I ever made. The difference between pivoting or grinding something out, I think, is you can only tell if you did the right thing in hindsight. And I could have if I went to the mortgage world and I took the easy way out of getting through the foundations, the business. But at the same time, like, I pivoted something that made more sense. I struggle with that in a couple of regards, but the main one is, did I take the easy way out or did I do what was right? And you really don't know that until, the chips have settled and that you've done you either figured out that it worked or it didn't. But it's like that classic, what got you here won't get you there, but you never know where here and there are. 6 years ago, I am certainly there, but today I feel like I'm here. Am I there? Am I here? It's certainly a tough philosophical conversation, I would say.
Well, I think that's one of those things, like, this is where the mindset component comes in, right? Because you can either be like, this is happening to me, or, hey, what can I take away from this?
Sure.
It comes back to, like, just having a growth mindset. Hey, is there something that I can go back and either that job sucked and that's it. That boss sucked and whatever, and you don't take anything away from it, versus, you know what, I can add this tool to my tool belt. And I did pick something up and, hey, I don't know if I can use this immediately in this next job, but if I can, awesome, let's build on that. And if not, okay, I'm going to tuck it away for later. This may come in handy later.
Yeah. I mean, it's the every little thing that you pick up. I look at, like, the jerseys on the wall, if you could draw an analogy of that, of things I've collected over the time. And every conversation I have with somebody, or that I'm on Zoom or Teams or whatever, or somebody's in my office, they talk about a different jersey up here. And the wall is a really good representation of the collection of experiences that you've had and how they relate to certain other people when they come in here. They said one of our guys' kids were in here and they're looking at they ran to the Packers helmet that I have over here. There's been 15 people in my office that could care less that I have an Aaron Rodgers Packers helmet in the office, right? They're more interested in the Marshawn Lynch jersey or whatever it is, right? There's different people connect to different things. And I think you only get those connections and you only explore those connections if you're open. And that's one thing that I really try to focus on, about being very open and part of my sleeve. Anybody around me knows that I'm very passionate about the things that I'm interested in, the things that I'm a big collector, obviously, and being open to those connections for everybody else to plug into accordingly, and being just an open wavelength for everybody to find something to connect with. Yeah. It
started factored into your success there with the lending company, because it sounds like the whole way it's, hey, you know what? You're learning how to build rapport. You're building connections out in your community, in the marketplace, which I'm sure now have paid kind of dividends back to where you guys are.
Yeah. All of my biggest clients in the real estate space, or the realtors or the borrowers, whenever I was in foundations, I went to them before I made the jump and said, hey, I'm a firm believer in dance to the one that brought you. We've worked together for a period of time already. If I need to personally make this move for myself, I would love to work with you in this other chapter of my life. I'm sure you probably have a lender already. I would ask that I don't necessarily unseat that lender, but I'd like a chance to do 1 or 2 deals with you and, like, eventually earn your business over there. The ability to have that conversation and come to them as a human and go, hey, we've had a good relationship. I am not going to ask you an uncomfortable question. I want to work with you over here and maybe mess up a relationship that you already have. Do we have enough rapport for you to, 1, me to ask you that question, and 2, you to respond to it in a positive way? And I was really pleased that most of the realtors and connections that I had there were able to transfer with me to the lending side. The problem was, a lot of the investors that we had, Fannie Freddie products don't work for the investor, generally speaking. Yep. So I was burning a lot of goodwill that I had with these clients because I was effectively shoving them into a product that wasn't the best fit for them. Now, I didn't know any better, because I didn't know the commercial lending world existed. It was just the best that I had. A guy that's on our sales staff now is the first sales rep that we hired. I used to work with at Thrasher. He had a real estate portfolio, and I knew he had real estate, and he knew I got into mortgages. So he called me up. He had a 5-1 arm that was adjusting from a local bank. He said, hey, I need to readjust. I had 20 properties all over there at this one institution or so. And hey, I need to refinance 1 out of this package. Well, Fannie Freddie require that I get documentation on all those properties, right? Because they're all liabilities that he's got, even if he's got a renter in them and he's getting paid. Going through a traditional Fannie Freddie loan, I got to get all the documentation for all those bad boys. And him, as he's used to working with a local bank that pretty much comes in and confirms that, yep, that's Josh, we'll give him the money. He was not prepared for the laundry list of things that Fannie and Freddie wanted me to collect. And again, I'm too dumb to know that there's the local bank relationships that are out there. In my head, Fannie and Freddie is the only thing that exists from a lending perspective. I don't have any context. I go, like, Josh, this is the deal. You got to give me this stuff if you want this deal. Luckily, the rates were good enough that he was able to put up with it. And we did that deal, but it wasn't as effective. Myself and Justin worked on that deal together because he was kind of shepherding me through these. And we actually pivoted and refinanced Josh's primary and paid off one of those rentals. So just looked at the problem upside down. He was giving us a refinance on an investment property. That wasn't the optimal way for me to do that, nor was it the optimal way for him to do it. Out of that, he winds up with a super low rate for his primary. He's very happy now, but it wasn't something that he was considering doing at the time. So that kind of encapsulates how Justin and I have always approached business and like interesting deals. Is I don't have a ton of context in the traditional lending space. So I look at, why can't we do that? What do you mean the minimum credit score is 620? Why? What's the difference between 620 and 619? Who decided that? Somebody in an ivory tower somewhere in New York that didn't want to trade 619 credit. They wanted 620 credit. How'd you get to that? Why? What's the difference between 621 and 619? You can't tell me. None of them can. And so, we've always kind of looked at that stuff upside down, and it's marked how we approach the lending sphere. So similar to the foundation space, where I didn't want a client to feel like I was another contractor. I wanted you to feel like I was a doctor in that case, to differentiate myself for that experience. I don't want our borrowers to feel like we're a lender in the traditional sense, where it's a very combative relationship between the borrower and the lender, where the lender's trying to find things to not do a deal. We want to start with yes, if, not no unless, right? And it's the same thing, just a different philosophy behind our willingness to do something. All these borrowers were hitting me up for Fannie and Freddie loans. I just didn't have a good answer for. And we started brokering commercial loans to the big players that you'd be familiar with, the Kiavis, the Lima ones, the Finance of America, all that stuff. But the hard part about working with those cats is, one, here in Wichita, Kansas, first off, nobody's ever heard of Wichita, Kansas. That was our rep. We barely had somebody in the central time zone. Usually somebody was covering us out of maybe Indiana, if they got that far out into the Midwest. Somebody out of Nashville or something along those lines would cover our account. Maybe Texas, if you were lucky. But even in the Texas, that might as well be a different state or a different country. The way we operate from them, you just have many people that understood the Wichita market. In Wichita, the 1% rule still applies. You can buy a meaningful rental for $85,000 today. It's still a great market. People come in from California. I can't believe I can buy what I can buy out here. The dollar stretches so much further. And so, convince the big Wall Street backed lender that my $100,000 refinance in Wichita, Kansas is, one, meaningful, two, not bullshit, because they're used to a $100,000 house not being worth the insurance it's covered on. And you just have such a story to tell. It's not worth their time. Similar to every other state and every other big metro, every borrower wants to close on the 30th of the month, the 31st of the month. It means the day we're recording this, it's the end of the month for us. It's a blitz over here. Everybody wants to close their business right now. In typical lending, the lenders are compensated based on the loan amount, right? It's a proportional payment or compensation. My $100,000 loan is peanuts compared to the $500,000 refinance in Destin, Florida, that the lender could prioritize. Of course, they're going to do that loan.
Our $1 million unit price here in Honolulu.
Yeah, man. You probably took precedent over a deal that I was trying to get done. And we just didn't understand it, because in Fannie Freddie world, if I check these boxes, USDA, VA, FH, they all owe me the money. That deal's got to get done regardless if you like the loan amount size or not. And so we conflated those two worlds, and we would, like the DSCR world and the commercial side, we call it commercial. It's really non-owner occ, but single family 1 to 4 stuff, not just multifamily commercial buildings, but we call it commercial to differentiate from the residential primary owner group.
And real quick, Matt, just because I know I've had these conversations, not everybody's familiar with what DSCR even means. Can you just break down that acronym real quick?
Sure. DSCR stands for debt service coverage ratio, AKA a cash flow loan, a rental loan. Instead of qualifying with your traditional DTI in the residential space, debt to income ratio, you're qualifying based on the income that the property produces against covering the mortgage that property is going to require. golden rule of that is we want to be north of 1, obviously, in terms of that ratio. We want to be making more on the property than we do in the mortgage, the cost.
Yeah. So real quick, guys. So he says like a DSCR, like a coverage ratio of 1, right? So it's basically a 1-to-1. Yeah. If the debt service is going to be $1,000 a month, right, and you're going to rent it out, then you want the rent to at least be $1,000 a month, and that can vary, right? Like
good business would say so, right?
Well, I've seen negative those 0.8 or
there's situations where you do it. There's situations where you need to do it, but generally try to avoid that stuff. Golden rule is maybe 1.15. You want to be cash flowing 50%. It's a good number to be at, but everything's situational. By example, we will do sub 1 on a DSCR. There's certainly outlets for that, and there's reasons and times when you would use a DSCR loan in less than a 1. But generally speaking, you're not making money that way. There's another reason behind those deals that typically. So the DSCR product is very attractive, and a lot of in the Midwest, for example, it's dominated by local banks and credit unions. And they require tax returns and W-2s and all the things that if you're a successful investor with an accountant that's worth their salt, you look bad on both of those, right? By design, you look bad. And the paradox is that you can't get traditional financing. So the DSCR product was created more of an income-focused product to finance real estate. And I'm still surprised that it's niche in some cases. And the fact that we still have to explain what DSCR is really exciting to me, for one, because there's a lot of value to be had out there for these investors who have stale equity in their properties that they can't otherwise touch. And so there's a lot of opportunity out there. But if the DSCR product is at all interesting to you and from your portfolio or optimization perspective, certainly reach out to us and we can look at those on a case-by-case basis. But the DSCR product is tough the DSCR product is has a guideline. It's got to meet certain requirements. It's really just a math problem. Same way as you do with the DTI in the residential space. But there's this underlying component with most of these lenders that we found in our market that they didn't like the properties for whatever reason. That just wasn't high enough value, or it's not worth our risk. And I was confused as the broker, who's obviously only getting paid if we do the deal. And then I represent my client, not the lender. Guys, this is a DSCR competition. This isn't a beauty competition. It doesn't matter if you don't like what the property looks like or you don't like this or that. The appraisal came back clean. There's no subject to. DSCR is 2 in this case, which for those of you who don't know, 2 is a ridiculous DSCR. We're crushing, but that's a common thing here in Wichita. You could get that based on the loan amounts and the amount of mortgage that's being taken out. That's a thing that happened. And we had good, clean deals with strong DSCRs, great borrowers, great liquidity, still get denied by the lender. Going, why? Explain. It's because we just didn't like the asset. And coming from the resi world, that's not a thing. Fannie Freddie don't get to decide if they like an asset or not. If the appraisal and you check all the boxes, they owe you money. And it's obviously government insured and all that stuff. So that's a different world. And we were blindsided by it. We misunderstood what was happening in the commercial world. And Wichita's a small town. You can only not fulfill your promises so many times before you start to piss people off. And we aren't okay with the product that we were putting out. Ultimately, as a broker, you're only as good as your partners. Our partners were failing us. To our borrowers, it didn't matter if it was the partner, us, the lender, the title company, appraisal. It all rolled up on us because we were bringing the party together. And out of respect to the clients, we stopped brokering. We decided we're going to raise our own fund. We're just going to control our own destiny. My partner, Justin, he's more of the quantitative math specialist. I run my mouth. He's the brains. That's how we work. We're a good yin and yang for each other. And so he's like, we could just do this. And so we did it. We got a capital partner, another big lender that we had brokered a bunch of stuff to in the past. We signed a joint venture, all this big stuff. And all of a sudden, overnight, we were a fund manager. It all happened so quick. They had a liquidity event so high level of how this was going to go. We would get a 90% loan by them. We would fill in the 10% for a client, allowing us to be at 100% loan to cost, which is very aggressive in the market, not to exceed 75% LTV. So 100% loan to cost, 75% LTV. Those were the 2 limiters for loans for us. Best example of a loan that fits a Dynamo Capital and why you'd want a Dynamo Capital. You're going to buy something for $100,000. Yes, you still can here in Wichita. You're going to buy something for $100,000. You're going to put $50,000 into it. It's going to be worth $200,000 when we're done. Okay. So I have a total need of 150 grand to get us to a $200,000 value. That's a good deal. You can make 50 grand in spread there. Dynamo Capital with bells on will show up with 150 grand for you. We'll give you 100 on day one. Then we'll set you up a rehab line of credit, essentially a rehab budget that you draw the 50K against to fill out the project. When it's all said and done, you either sell that thing for 200, you pay me off 150, you make your 50 net of fees, and then you go on down the road, or you refinance into a long-term DSCR loan for 75%. You now have a cash flowing property by definition of the DSCR, and you didn't have to inject any of your equity into the deal. Thus, we are an equity-free equity partner. That's the Dynamo pitch. We were getting a partnership. Justin and I, maybe we could scrape together 100 grand between the two of us, right? When we started this. And that was calling on everything, cashing everything out, friends and family, sell something here or there, whatever, right? We were scrapping to get to that. And we started the fund. We had this partnership, 90-10. We had $1 million worth of loans lined up. All we had to do was chip in 100 grand. We were brokers, so we didn't know how to run a fund. We didn't know how to be a lender. There is so much that goes on behind the scenes that is a lender, right? Whether it's like managing payments or collecting payments or sending out draws or statements or monthly statements. You ever made a monthly statement? I sure as hell haven't. So we learned all that stuff in kind of this beta test. We had this group of loans. It was $1 million worth of loans that we were going to be doing. Within the first week, before we funded anything, the lender that we were partnering with had a liquidity event, is the professional term. And they essentially left us on the goal line. We didn't have any money. They said, hey, something else come up, can't get it. Sorry about it.
The liquidity for our listeners, like what Matt's getting at there is like, there was a liquidity event. Basically, the liquidity dried up, the capital dried up or whatever. And so they no longer had that money to be able to offer to Matt and Justin as partner.
Left us holding a $900,000 bag plus the $100,000 that we had to kick in ourselves. I mean, we were literally just I was going through my phone, calling people, hey, need $1 million. By when? Tomorrow would be great. We could do the end of the week. And that was the call I had. And by the grace of God, dude, we found $1 million. And we didn't miss a single funding. We kept every one of our promises. The worst thing you could do as a lender is not have the money that you need to lend out. Devastating start to a lending operation. We should have been strangled in the crib. We figured it out. We gutted that out. And back to the point of callback of, should we have pivoted or should we have grinded that out? I'm glad we grinded it out. Common sense at the time would have said, pivot. We don't have the money for this. So let's bail out. But we kept calling and we pushed through that. So you tell me when you should pivot and when you should keep doing something. Again, it's only in hindsight. So I'm glad we did stick it out. And it forced us to diversify our capital. We probably grew 5 years of like company growth in like a week because we realized we were going to be a $5 million fund. That's what we were going to raise. It was going to give us $50 million of lending capacity with that partner. We raised a fifth of that on day one and $1 million with that group that we went, or that group of loans that we went out and funded. It forced us to grow up and drop this rose-colored glasses of we'll have partners that'll work with us and whatnot. And look, it's only on us. If we're going to win, we're going to do it on our own. And we're going to not have to answer to anybody. We're going to go out and control our own destiny. So that was the philosophy. I'm glad at the time, man. I have more gray hair from that than I care to acknowledge. But we shouldn't have made it through that, but somehow we did. I'm glad we did at the time. I hated it. It was miserable. Immediate regret. I should have stayed at Coke. I could have made $56,000 a year and it would have been way better than this shit. And then Alta come out and this is what we've built. I'm glad we did, but man, it was dark for a while. It was just me and Justin essentially in a broom closet at the beginning of this thing, trying to make it all work out. And I'm glad it did. But yeah, it did. I'd love to say we never wavered and there was never a doubt in our mind that we were going to get this done. But hell yeah, there were doubts, man. I didn't think we were going to make it. I didn't think we were going to make it for a second, but we didn't have a choice. So we did our first beta test through the end of 23 and built out a lot of like the infrastructure of the fund. And then 24 kind of reopened, started taking in our first real capital at the top of Q2 of 24 and started doing our first bulk of loans. Our first year, the fund, past performance, no future performance, all the asterisks, consult your accountant, your attorney, this is not an offering. I'm not selling you anything.
We're just three guys talking shop.
Our first real year, we did north of 30% net to our investors after splits and after everything. And that was also exhausting. We were running very thin and stressing, because the hardest part about running a fund is like, you have to have deal flow. You also have to have capital to support that deal flow. How do I get capital? Well, I have to have deal flow. How do I confidently go out and get deal flow? I got to have capital to back it. Luckily, we knew that we had a good lead on capital. So we went out and found a deal, and then we'd raise for the capital or raise for the deal. Stressful as hell, man. It was tough. Our capital utilization rate was a little bit higher than we would care to acknowledge or live through again. So we're not doing that. We really shift our strategy, more conservative growth. But yeah, I'm happy to say, man, today we're north of $100 million fund, total assets under management. We've done almost 350 units since we began. We've paid out over $7.5 million in distributions to our investors. Never lost a dollar of fund capital, knock on wood. Yeah, and we're at over 30 employees across the country now. We're still mainly focused in the Midwest. But finding private lending talent in Kansas is virtually impossible. Most of our staff, we had to teach how to spell that there were 2 G's in mortgage, for example. We're a little bit more remote than we've ever been in the past, but we've got some really phenomenal talent that's helped us grow this company and beyond what we thought it could be, what we wanted to be. When we've given up trying to decide what we will be, man, we're going to keep doing the next right thing. And as big as this thing gets, is as big as this thing gets. And we're happy either way on how this goes. Don't mistake that for a lack of vision or direction. It's really, we're just not forcing it. We're maybe in a Hawaiian sense, just kind of going with the flow, and we'll grow as we grow and do the next right thing, man. That's the only thing we do here.
Right on. That's awesome. No, thank you for sharing that. Thank you for sharing me again too. Like we talked a little bit about this off camera, where everybody wants to shout from the mountaintop. Oh, I'm amazing and everything is rainbows and sunshine and like this, but it's not the reality of entrepreneurship. And I'll be honest with you. Okay, if somebody just hears, oh, okay, hey, I'm a fund manager and we've done $100 million for the transactional volume or whatever. You throw out a bunch of statistics. You're thinking like it is somebody in an ivory tower that you made mention of earlier. Right. And but what I'm getting from you is, man, no, hey, even with all the success that you guys have had, hey, if I bring you a deal and I need to get funding for it, like you guys still have the mindset of, no, we're scrappy. We're going to make it happen. We're problem solvers. And I think this actually comes back to where you pivot and goes a completely different direction versus like when you press forward is, hey, where have you built momentum? And I think at that point, hey, you know what? No, actually what we're doing works. We just have obviously a key component drop out on you guys with their liquidity event, but if we have that piece, this works. So it's, hey, you've already built momentum. XYZ is happening. This is working, but we just need these other components. And again, you did press on, and obviously that helped you to grow more sustainably longer term, set you up more for success. Now, thanks for sharing that, because I think a lot of people, like I said, are not willing to share in the failures or any of the challenges. And it's, man, that's just not life. You know what I mean? That's not reality. That's not how life works in any capacity. So why would we expect that to work in businesses? And you guys you're transparent enough to say, hey, no, this is it. And hey, we're willing to work for you, and we'll get dirty for you. Not in the crawl space, not with the bugs, but
you know what? Maybe for one time's sake or through the old time's sake, I'll do it. But I think one of the big things that's differentiated us is I literally don't look like a fund manager, right? I'm in a turtleneck, the most dressed up I've ever been this month. Is chilly here. We're not suits guys. We're younger. We're 30 and 29, heavily tattooed, for example. Like a lot of things that separate us from the traditional ivory tower, New York, Wall Street backed lender. One of the things that we've always tried to do is bring the Wall Street backing and understanding strategy to Main Street, Wall Street to Main Street, and then make it work for us on Main Street. Because we had a chip on our shoulder because nobody on Wall Street ever, I'm using the term Wall Street, you get the point. Nobody on Wall Street ever wanted to work with us. And so instead of waiting for them to come to our rescue and save us, we decided to do it ourselves. And the traditional path for these lending shops is they understand that there are flow relationships, a little bit inside baseball. They understand there are flow relationships and ways that you can do a lot of volume and never really put your own skin in the game. They were traders. Most of these lenders were traders in the day. They realized they could make spread on mortgages, so then they trade those things. We were mortgage real estate guys that got into like capital movement and trading. And so we've come at this industry from the opposite direction, where most of them come from Wall Street and they get into real estate. We came from real estate, got into Wall Street. And so we didn't realize until we were hiring for our capital markets position that we built the fund backwards compared to most people. Most lenders, generally speaking, start out in a flow relationship where they prove out the concept of like, here's the box that we're going to lend in, and we're going to have these relationships where bigger lenders buy our loans from us, and we table fund, which is AKA brokering these loans, and we're going to use somebody else's money, and we just leverage these relationships, and it's a shell game.
It's arbitrage, and they're just shuffling paper.
Yeah, exactly. Where we didn't even know that even existed. We didn't know that was a relationship that you could have. We figured out, we thought if we want to lend money, we better go raise money, create value there, and then go lend it out to borrowers that want it from us. And then we realized that, we could start to build a little bit more volume by leveraging these relationships around us. And we were talking to a capital markets candidate that said, now that we've proven out our concept, we're going to go out and raise a fund. And I'm like, wait, you guys didn't start with a fund? And they're like, no, God, no, that's so hard. And I'm like, well, we did, right? So we just haven't taken a traditional path. And I think that's what's been refreshing to our investors, to our borrowers. Yeah, because when we started, and I always wanted it to be that you need a draw for your deal, FaceTime me and show me that you put the floors in. I'll send you a draw for the floors. At scale, that's a little bit harder to manage. You can't do that. We've got to have systems and processes, and there's more diligence and call them hoops, but it's really protect us and protect the borrower. Yeah. Despite what the borrower will say, it's more work for me to get a draw here versus this mom and pop. It's not. And we're doing this. So one, when you come to taxes, you can explain how much you spent. When we show all the work that's been done and you got clean accounting, like we expect you to be a professional borrower, and we're trying to raise that up in our borrowers. And so, we're never going to apologize for raising the bar of lending in our local market. We really don't have this question when we come to a bigger market like Denver or Kansas City because they're used to it. But Wichita is a really immature market. It doesn't have a ton of this context. So you can get away with it. Just the guy sent me classic example here for a private lender. I bought a house worth $100,000. It's going to be worth $200,000 when I'm done after this $50K. The guy sent me all $150,000 on day one. That's great for him, but that's a hell of a risk. We're not interested in doing that at the fund. I've got investors that I have to protect. I'm not shipping you $150,000 for a $100,000 house. That don't work. It just doesn't. I'm not going to make any bones about it. I'm not going to apologize for that. We're going to have some processes in place to protect both us and you. If I get $50,000, that thing gets wiped out by a tornado. We live in Kansas. It happens. What are you going to do with the other $50K you owe?
Yeah.
The insurance only going to give me $100,000 for it. We got a problem with there's $50K. We got to figure it out. So it's just as much to protect us as to protect you. And I think as a lender, it's on us to explain that to borrowers. And when you talk to a borrower and you explain like the tornado example, you go, oh, shit, I never really thought about that. That's a good point. Keep the $50K and we'll work this out. Yeah, just lending doesn't have to be difficult. It's oftentimes mystified with a bunch of fancy acronyms that even the lenders themselves can't agree on how to spell. I didn't think I'd have to LTV, LTC. There's a healthy debate over what gets calculated in that. You'd be shocked. It's in a lot of ways the blind leading the blind, and we're trying to bring some clarity with just some basic straight talk of here's what the costs are, here's what the value is, here's what I'm willing to give you. Let's go do this deal. And at the end of the day, what we sell is successful outcomes for our borrowers. We've done over almost 350 transactions. And to date, I don't know that we've completed more than 1 or 2 foreclosures for whatever reason. And I don't even know if that's actually true that we've gotten that many officially. We really want to be a partner to the borrower, help work with them. We don't want to take properties back. We don't want to own them. That's not our strategy. We don't gain anything as a company or as a community by taking properties back and making private lending difficult. You're better off to run your project than I am. I don't want to do it. I want you to be a professional borrower, do what you say you're going to do, spend the money on what you say you're going to do it. Of course, we got to do some checks to make sure that we're being diligent with our funds. But beyond that, man, do the right thing. We'll do the right thing. We've made 1,000 mistakes as a lender. It was our first time doing it. We made 1 million of them. We've never not fixed a problem that we've made though. Right. And we can only fix problems that we know about. Open communication, or when we just do the right thing. It's the easiest way to run businesses.
I think it's super refreshing to hear. And you guys have obviously carved out a niche for yourself there in Wichita. I think the clients appreciate that. Matt, if our listeners want to get in touch with you, they want to learn a little bit more about, hey, they've got a project, maybe it's not directly in Wichita, in another market that maybe you guys service. What's the best way for them to reach out and get more information about you guys?
You can submit a loan request to dynamocapital.com. There's a link on the website. We are nationwide, generally speaking. Some states require licenses that we don't necessarily procure. For example, no California or New York today. If we hit it big and we wind up moving out to LA, maybe I'll start an office out there, but that's not necessarily something we do today. But yeah, there's really no deal that we won't look at. We're obviously focused on the single family 1 to 4 stuff, but we've done quite a few commercial assets that were common sense. Quick bridge loans for banks that run otherwise too slow. We step in, fund a project as a floater until they can run through your taxes and your W-2 all the way that makes them comfortable. So there's a lot of times for Dynamo to step in. We're not necessarily here to unseat other lenders. We're here to work around them and help around the confines that they're under and run smooth, quick deals. You can reach out to us at dynamocapital.com or any of our emails. Mine's Matthew at dynamocapital.com. We'll get you in touch with the right person if you need anything.
Awesome. Hey, thank you so much for taking time out of your day, lifting, as in Hawaii, we would say, lifting the kimono a little bit to see a little background of the lending industry. But no, I appreciate your straight talk. And I think that, like I said, I think you guys have been successful because the clients appreciate that too. It's easy to see you guys being, hey, you know what? You're not just a lender, you are a partner with them and trying to get their deal done, not just some cold bank that they're scared to come and submit documents to. No, I think that definitely comes across. So now thanks for hopping on. I would look forward to circling back with you and maybe in 2026 or later on in this year, by the time you guys are listening to this episode, to see, hey, not only what additional success you guys have taken on, but really to see the next level of growth for the business. Because you guys, if you can make it during this, higher interest rate environment, I think this is the proving grounds, I think, for most businesses. And yeah, we'll definitely look forward to seeing you guys progress later down the road. But yeah, no, thanks again for hopping on with me today. I greatly appreciate it. I think our listeners have also learned quite a bit. Thank you. And we'll look forward to great success for Dynamo and you and the rest of the team. So happy New Year. And we'll look forward to circling back with you in the future. All right. A great conversation with Matt Medrano talking about lending over at Dynamo Capital, Dynamo Lending. Yeah, great insight behind how lending works and the differences between residential, commercial, and commercial lending more just in the investing space. Obviously, not necessarily just commercial real estate, but just how a commercial type product works for residential lending. And obviously, he's got an inspiring story, lots of stories of kind of him growing up and his career and how, hey, look, you can pivot too. Don't be scared. Like, this is just part of the process. But yeah, check them out over at Dynamo Capital. Make sure we'll put some links for their sites and whatnot down in the links below. And of course, if you guys are interested in investing with us, so you can go to tricityequity.com. You can learn more about prior deals that we've done. And we'd love to have a conversation with you and see if maybe there's some way we can work together. If you're interested in connecting with us locally, we host meetups every month, Honolulu multifamily and more. We've got another meetup coming up, no matter when you're listening to this. So make sure you connect with us there. You can find us on a variety of different platforms. We'd love to be able to meet you if you're here in the Honolulu area. And then, of course, like, subscribe, share the episode. We'd love to continue to provide more and more value to the listeners. The only way we can do that is partnering with you. So we appreciate you guys. Thanks for tuning in. And here's to an exciting 2026. Take some action, guys. And we'll look forward to seeing you in the next episode. Aloha.